Well, now to the broader market as stocks do get hit hard to start the week. Let's bring in Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. Lori, good to see you.
Thanks for having me.
So I assume and know you've been stress testing your kind of fundamental view and general market take for $100 oil, how long it lasts. What do you get when you do that?
So we have 5 different models that go into our year-end forecast, sort of process or 12-month forward process. And we took one of those models, our valuation and earnings test. This is the easiest one to kind of run through this scenario on. So for the earnings assumptions, I went back to 2022 and 2015-16. 15-16 was flat earnings. 2022 was 5% earnings growth. So we took those 2 numbers for earnings. Then we went to our PE assumption and we baked in 3.6% headline inflation, which our economists have done their own stress tests on $100 oil, and that was one of their outputs for 4Q. So we threw that in. I added in 4.5% on 10-year Treasury yields, honestly, just to put some stress in the model, and I left the Fed flat because I didn't feel like that was really in the zeitgeist at the moment. And what I came up with was basically 6,600 to 6,900 is fair value, which is kind of this range we've been stuck in. So the idea that we may be baking in some stagflationary impact, you can make a reasonable argument that it's there. Now, if you want to take the bear side on my model, that was my strongest model. It had been forecasting over 8,000 over the next 12 months. So you lop 1,000 points off of that. That doesn't feel so good, but it does give you some comfort when you can run through the numbers, at least that we have a decent starting point.
And then in terms of, I guess, more the tactical picture, it's kind of interesting. A lot of commentary this morning saying, well, look, the market doesn't quite look very washed out. You could look at, people are paying up for downside protection. There's no doubt, but maybe not at extremes. You have seen, sort of the market get oversold at an index level, but not the average stock because the market's been trying to escape through rotation. So where does that bring you in terms of whether we've done enough? Because, the PE, forward PE has come down 2 points since October. Yeah,
when we just look at the bottom-up forward PE, we're down to 23 times. And I forget how high we were. I think it was maybe close to 30. It was 25 a few weeks ago. What we saw in 2022 was that version of PE went down to the long-term average, and that helped mark the low and the bottom of the market. That average right now is about 18.5 times. So there's still some wood to chop there. I like the Russell 2000 better as a broader barometer for these kinds of stress periods. If you look at 2022, 2023, and then 2025, the big drawdowns we had those years, small caps started baking in a recession. In 2025, around the tariffs, we got to 12.65 times, and 11, 13 times is recession pricing. Small caps are down to 16.1. The average is 15.2. So again, a little bit more wood to chop. But you look at how quickly small caps are getting hit. That's probably going to be the better barometer to help us gauge a bottom here.
What is the history of oil spikes and shocks like this on corporate earnings? How long does it last? How big of an impact?
It's a great question. I don't have that answer off the top of my head, but we did go back and look at the post-COVID environment, and we found a minus 40% inverse correlation between stocks and the oil price. And that was much more powerful than what I would have thought. I mean, it's not 100% correlation, but it is pretty meaningful. And we did a sector study or an industry group study, and it's funny, the only industry that tends to rise in the post-COVID environment and outperform the market is energy. So you don't get a lot of help. What you're looking at in the rest of the market is sort of degrees of underperformance. And so you can find areas, like healthcare, both the pharma side and the healthcare equipment and services side, not really direct impacts to earnings. And you do see some resilience in those stock prices if you look at the history.
But is it all just near term based on the oil price move, or does it matter how long this lasts?
I think it matters how long it lasts. I will tell you, Sarah, I went to my analysts last Tuesday and Wednesday, and I gave them a survey. And I know they were thrilled with me that I give them a survey in the middle of everything that's going on. But they did all fill it out, and they filled it out pretty fast. I went back to them at the end of the week to reconfirm their results. And we said, gauge the impact to earnings, gauge the impact to direct revenue exposure from the Middle East, and gauge the knock-on effect impacts, from this conflict. And we said specifically assume oil goes to $100 or more for an extended period of time, and this conflict lasts more than 4 weeks. And so those were the parameters we gave them. There were 4 sectors where we basically had most analysts say the impacts would be low on all 3 of those questions: healthcare, financials, utilities, and communication services. So there are some decent pockets of resiliency, even if we start to bake in worst-case scenarios.